Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors. Had plenty of volatility pickup this week. A couple of our indicators really started to flash red, and we've discussed this on past videos. And that's that speculative call and put buyer. We saw last Friday, got the data over the weekend into Monday, record amounts of calls being bought by the speculative options buyer. By speculative, I mean 10 contracts or smaller. Highly emotional, highly susceptible to greed and fear. Remember back late March when we saw the equity-only put-call ratio crack 120 on the upside. A tremendous amount of fear in the market. Well, we got the flip side of that last Friday into Monday. Calls. That was a wonderful signal to just be aware of, that you have so much fast or greed money in the market that we may have to pause. And that's what we saw this week. By the way, this pullback is healthy across the board. We're really back to late May, first couple days of June levels. So we're back to 10, 15 days ago levels. We went up on a stem. You know, traders are aware when you run up on stems, the pullbacks are going to be nasty. There's nothing to pull back into. There's no demand. There's been nothing created in terms of bases. So that's what we got. And some of the stronger names in some of our portfolios really have pulled back into spots that are attractive, especially on the tech side. If you look at a Microsoft, if you look at an Adobe. But even the value and small and mid, which had such a nice run April through May, have pulled back into a spot that is certainly reasonable to look at entry. Again, it's back to late May, early June. So we've got a great battle going on between the economy and headlines, led by COVID, with China and trade situations right behind that. You have continued pressure, continued headlines, continued video of protests. That makes for a potpouri of dangerous situations on a day-to-day basis. So from a macro level, things look dicey. From a micro level, when we start digging down into companies, you see some companies that look very attractive here. Some sectors that look very attractive. Some balance sheets that look very attractive. So we'll continue to dig. We have cash in our U.S. portfolio. Our latest trade had been to let go of some of the telecom/networking stocks through an ETF. That brought us up to just above 20% cash. That was late last week. In our international portfolio, we did take advantage of that rip in Latin America to sell into that. Latin America is having all sorts of trouble with the virus. Had a 30% move in 2 weeks. We were happy to sell into that. That took cash in our international portfolio up to 16%. Tactical, little higher, 30% in tactical. Strong names. On Wednesday, most of the portfolio, 3/4 of the portfolio hit annual highs. So this pullback is a welcome pullback as long as demand shows up. So let's see what these next few days bring. Let's see what the bond market does. If there was a fly in the ointment, it's the fact that that 10-year, which had yield-wise had rallied all the way up to 90 basis points. You recall John and I speaking about it last week. Back down to that 70 area. You know, it's that fear that the economy's not going to come around. It's not something that we know. It's not something that you know right now. It's going to be a grind. It's going to be a week-to-week, month-to-month grind of the economy opening up versus the virus and how stocks price in that information. Have a great weekend.
Hi, it's John Mousseau. It is after the close on Friday, June 12th. Weekend bonds, yields down. We saw Treasury yields move down across the board. 10-year bond went from 0.9 to 0.7. It got as low as 0.65. 30-year bond went from 1.7 to 1.45. Got as low as 140. Sharp move down, certainly in sympathy with what we saw went on in the equity markets. Muni bonds, great receptions on all deals this week, multiple times oversubscribed. You saw muni yields move down about 10 basis points in the longer end. So not nearly as strong a move as treasuries. That's to be expected when you see a strong treasury move in the wake of a tough equity market. But no question, munis have made a total round-trip turn through the carnage of March, where we saw long muni yields go from below 2% all the way to 4%, came partway back, now they're all the way back. So you wouldn't know the bond market in munis is any different now than it was at the end of February, with one big exception, that treasury yields are now much lower than they were back at the end of February. So munis continue to be a very good buy on a relative basis. We're seeing that in the market. Saw the Fed this week basically say they're still looking to help markets as needed. They said the economy is not out of the woods yet. Certainly the economic numbers still concern the Fed in spite of the employment number a week ago. And I think what their Fed is saying, we are going to keep interest rates low for a while. And certainly until you see people back to work and an employment number that is better than it's been. I think what that means for us, we want to own things that are not treasury. So on taxables, we want to own some agencies, certainly good doses of high-grade corporates and taxable municipal bonds. On the muni side, tax-free side, we want to own longer paper, longer duration paper, for two reasons. One, it's a better buy versus treasury, so you're getting some better values there. Number two, we think that no matter who becomes president, whether it's President Trump being reelected or Vice President Biden being elected, that higher tax rates on the federal side are coming. And that would make every municipal bond worth more the day after that tax rate hike than it was the day before. So that is the weekend bonds. We hope everybody has a great weekend. We look forward to talking with you next week.